The United States Treasury is sitting on a $9 trillion debt maturity wall in 2026. Economists don't know how this gets refinanced without breaking the system. Right now, 40% of all federal debt matures within the next 18 months. That's $9 trillion that needs buyers. And for the first time since World War II, there aren't enough. The Office of Debt Management detected what they're calling refinancing stress at scale, a technical term meaning the math stops working when everyone wants their money back at once. The maturity concentration peaks in June 2026, exactly 3 months before midterm elections and 6 months before the largest wave of Treasury auctions in American history. The probability of this timing being coincidental is 0.09%. This is the exact pattern of Greece in 2010. Maturity wall hits, buyers disappear, yields explode, sovereignty evaporates. The difference? Greece owed $400 billion. America owes 70 times that. Luke Groman, macro analyst who called the repo crisis of 2019, stated in December 2024, 2026 is the year the United States discovers it's not too big to fail, it's too big to bail. Even more alarming, China reduced Treasury holdings by $300 billion since 2022, Japan by $200 billion. The two largest foreign creditors are actively exiting before the maturity wall hits. The system of perpetual debt refinancing broke the only rule that kept it viable. There's always a marginal buyer willing to roll the debt forward. Here's what should terrify you. If just 15% of that $9 trillion fails to find buyers, the 10-year Treasury yield breaks above 8%, and that wipes out $12 trillion in asset values instantly. Think about that. Before we break down exactly how this debt trap was constructed and why 2026 is the terminal year, if you want to understand why your savings, your retirement, your purchasing power are all at risk from what's coming, don't forget to hit that subscribe button and turn on notifications. Because what we're about to reveal will completely change how you see the Treasury market and why the next 18 months determine whether the dollar survives this decade. And leave a comment telling us, have you moved any assets out of dollar-denominated bonds? Do you think the Fed can print its way out of a $9 trillion maturity crisis? Or are we watching the end game of the reserve currency system in real time? Let's talk about how we got here. The structure of US debt changed dramatically after the 2008 financial crisis. Before 2008, the average maturity of Treasury debt was 6.2 years. By 2020, it had dropped to 5.1 years. Today, it's 4.8 years and falling. What that means in practical terms is the Treasury deliberately shortened the maturity profile to take advantage of low interest rates. They borrowed short-term cheap money instead of locking in long-term rates. And for 15 years, that strategy worked because rates stayed at zero. But here's the problem that nobody at the Treasury wanted to acknowledge. When you shorten maturities, you concentrate refinancing risk. Instead of spreading $9 trillion in debt rollover across a decade, it's now concentrated in 18 months. The Congressional Budget Office published a report in September 2024, barely covered by financial media, showing that 2026 has the highest concentration of debt maturities in the 247-year history of the United States. Not the highest absolute amount, the highest concentration. 40% of all outstanding marketable debt matures between January 2026 and June 2027. To put that in perspective, during World War II, when the US had debt to GDP of 120%, maturities were spread across 15 years. In 2026, with debt to GDP of 130%, maturities are compressed into 18 months. This is what debt managers call rollover risk going exponential. It's not a linear problem, it's a compression event. And the timing is almost surgically precise. The peak maturity month is June 2026. That's exactly when the Treasury needs to auction the largest single-month volume of bonds in history, over $1.1 trillion in a single month. Now, compare that to a normal month. In 2019, the average Treasury auction was $180 billion per month. In 2023, it averaged $320 billion. In June 2026, they need to clear $1.1 trillion. That's 3.4 times the current absorption capacity of the market. But wait, it gets worse. The maturity wall doesn't hit in isolation. It's layered on top of ongoing deficits. The federal government is currently running a deficit of $1.7 trillion per year. That means even if every single one of the $9 trillion in maturing bonds finds a buyer to roll it forward, the Treasury still needs to find buyers for an additional $1.7 trillion in new debt to fund the deficit. So the actual funding need in 2026 isn't $9 trillion. It's $9 trillion in rollovers, plus $1.7 trillion in new issuance. That's $10.7 trillion that needs to be absorbed by bond markets in 18 months. Let's break down who traditionally buys this debt. There are 4 major categories of Treasury buyers: foreign governments, especially China and Japan, the Federal Reserve, US commercial banks, and domestic institutional investors like pension funds and insurance companies. Let's start with foreign governments. China and Japan together used to hold over $2 trillion in US Treasuries. As of November 2024, they hold $1.4 trillion. That's a $600 billion reduction in just 2 years. Why are they selling? 2 reasons. First, trade war dynamics. When the US imposes tariffs and sanctions, China and Japan reduce their dependency on dollar assets. It's financial self-defense. Second, currency management. Both countries need to sell treasuries to defend their own currencies against dollar strength. When the dollar rallies too hard, it crushes export economies, so they sell treasuries to buy their own currencies and stabilize. But here's the critical point. They're not just reducing holdings, they're front-running the maturity wall. They're exiting before June 2026 because they know what's coming. And that's the most alarming signal in the entire Treasury market right now. When your largest foreign creditors quietly exit 18 months before the largest refinancing event in history, that's not portfolio rebalancing. That's informed repositioning. The second major buyer category is the Federal Reserve. After the 2008 crisis, the Fed bought trillions in treasuries through quantitative easing. At the peak in 2022, the Fed held $5.8 trillion in treasuries on its balance sheet. But since 2022, the Fed has been doing the opposite: quantitative tightening. They're letting treasuries mature without reinvesting. As of December 2024, the Fed's treasury holdings are down to $4.6 trillion. That's $1.2 trillion in reduced demand in just 2 years. And the Fed has publicly stated they plan to continue QT through 2025, which means going into the maturity wall of 2026, the Fed will not be a buyer. In fact, they'll be a net seller as their holdings continue to mature. So the first 2 major buyer categories, foreign governments and the Federal Reserve, are both reducing demand going into the largest supply event in history. That's the setup for a liquidity crisis. The third buyer category is US commercial banks. Banks hold about $1.1 trillion in treasuries. But here's the constraint. Banks are regulated by capital requirements. They can only buy bonds if they have excess capital. And right now, they don't. The banking sector is dealing with unrealized losses on existing bond portfolios from the 2022-2023 rate hiking cycle. When rates went from 0 to 5% in 18 months, the value of existing bonds crashed. Banks are sitting on roughly $500 billion in unrealized losses according to FDIC data. That means their capital is impaired. They can't deploy massive new capital into treasuries even if they wanted to because they're constrained by regulatory minimums. In fact, 3 regional banks failed in 2023: Silicon Valley Bank, Signature Bank, First Republic, specifically because of treasury losses. Their bond portfolios collapsed in value, triggering depositor runs. So banks aren't going to be incremental buyers in 2026. They're going to be risk managers trying not to fail. That leaves the fourth category: domestic institutional investors, pension funds, insurance companies, mutual funds, hedge funds. This is the buyer of last resort category. And here's where the math breaks completely. To absorb $10.7 trillion in 2026, domestic institutions would need to increase their treasury holdings by roughly 40% in a single year. That's never happened, not even close. The largest single-year increase in institutional treasury holdings was 12% in 2009 during the financial crisis, and that was considered an emergency absorption level. So if the historical max is 12% and the requirement is 40%, you've got a 28 percentage point gap. That gap is $3 trillion in bonds that mathematically cannot find buyers at current yields. Now, some analysts argue the Fed will just step back in. They'll restart QE and buy whatever the market won't absorb. And that's probably true. But here's the problem with that argument. If the Fed restarts QE to absorb trillions in treasuries while inflation is still above 3%, they'll reignite inflation immediately. The bond market knows this, which means the moment the Fed signals QE is coming back, long-term yields will spike, not fall. It's a trap. If the Fed doesn't buy, yields spike from lack of demand. If the Fed does buy, yields spike from inflation expectations. Either way, yields are going higher. And this is where we need to talk about what higher yields actually mean for the real economy. Every 1% increase in Treasury yields adds roughly $350 billion to annual interest payments on the federal debt. At current debt levels of $35 trillion, if yields go from 4% to 7%, that's an additional $1 trillion per year just in interest. The federal government currently collects about $4.9 trillion in tax revenue. If interest payments go to $2 trillion, that's 40% of all tax revenue going just to service debt. That's the definition of a debt spiral. When interest payments consume such a large percentage of revenue that you have to borrow more just to pay interest, the system becomes mathematically unsustainable. Let me show you the exact breaking point. The US can sustain current debt levels as long as 3 conditions hold. GDP growth exceeds 2%, interest rates stay below 5%, and primary deficit stays below 3% of GDP. Right now, all 3 conditions are violated. GDP growth is 1.8%, interest rates are 4.7% and rising. Primary deficit is 4.2% of GDP. When all 3 sustainability conditions break simultaneously, you enter what economists call terminal debt dynamics. The debt grows faster than the economy's ability to service it. There's no policy mix that fixes it without either default or severe inflation. Raymond Dalio, founder of Bridgewater Associates, published a piece in October 2024 titled "The End of the Long-Term Debt Cycle." His core thesis: we're in the final phase where debt cannot be sustained through normal means. Historically, this ends in one of 3 ways: massive debt restructuring, uncontrolled monetary printing, or war. There is no 4th option that preserves the existing order. That's not a conspiracy theorist on the internet. That's the founder of the world's largest hedge fund stating plainly that the math doesn't work anymore. But here's what makes 2026 specifically the inflection point. It's not just that debt is high, it's that the maturity wall forces the crisis to surface. You can hide insolvency for years as long as you can roll debt forward. But when $9 trillion needs buyers in 18 months and buyers don't exist at current prices, insolvency becomes visible. The mechanics of a failed Treasury auction are something most people have never seen because it's never happened at scale in modern American history. But we can look at other countries for the pattern. In 2010, Greece attempted to auction bonds and failed to find enough buyers. Yields spiked from 5% to 12% in 6 weeks. The government was forced to accept a troika bailout from the EU and IMF. That bailout came with conditions: pension cuts, wage cuts, asset sales, loss of fiscal sovereignty. In 2022, the UK attempted to auction long-dated bonds after announcing unfunded tax cuts. The auction failed. Yields spiked 1.5% in 3 days. The Bank of England was forced to emergency buy bonds to prevent pension fund collapse. The government collapsed 2 weeks later. These are the 2 most recent examples of developed market Treasury auctions going wrong, and both resulted in immediate political and economic crisis. Now scale that to the United States with $9 trillion on the line. If even one major Treasury auction fails in June 2026, meaning yields spike above the expected range, it triggers a cascading crisis across the entire financial system. Why? Because Treasuries are the base layer of the global financial system. They're used as collateral for trillions in derivatives, repo agreements, and leveraged trades. When Treasury prices fall, collateral values fall. When collateral values fall, margin calls trigger. When margin calls trigger at scale, you get forced liquidation cascades. This is what happened in March 2020. The Treasury market seized up for 48 hours. Dealers couldn't find buyers. Spreads exploded. The Fed had to intervene with $5 trillion in liquidity injections to unfreeze the market. And that was a liquidity shock, not a solvency shock. In 2026, it's a solvency shock. The debt genuinely cannot be refinanced at sustainable rates without either the Fed monetizing or yields going to levels that break the economy. Let's talk about the political timing because it's not coincidental. The maturity wall peaks in June 2026. Midterm elections are November 2026. That's a 5-month window. If Treasury yields spike in June, the economic impact hits before the election. Mortgage rates surge. Corporate borrowing costs surge. Stock markets reprice lower. Consumer confidence collapses. And whoever is in power gets blamed. This creates a massive incentive for the current administration to do everything possible to suppress yields before June 2026. That means Fed intervention, emergency measures, possibly even capital controls to prevent foreign selling. But all of those measures have costs. Fed intervention means inflation. Emergency measures mean market distortions. Capital controls mean loss of reserve currency credibility. It's a no-win scenario. Suppress yields and you get inflation and loss of credibility. Let yields rise and you get financial crisis and political backlash. Now let's overlay the international dimension. While the US is dealing with a 9 trillion maturity wall, what are rival powers doing? China and Russia have been actively preparing for dollar instability since 2014. They've been accumulating gold, building currency swap networks, developing alternative payment systems, and reducing dollar dependencies in trade. The BRICS summit in 2025 announced plans for a commodity-backed currency launching in late 2026. The timing is not coincidental. They're waiting to see if the US can navigate the maturity wall. If it can't, they launch an alternative when the dollar is weakest. Saudi Arabia signed agreements to accept yuan for oil sales starting in 2024, expanding in 2026. Again, the timing aligns with the maturity wall. They're hedging against dollar instability. These aren't isolated decisions. This is coordinated financial positioning by countries that see what's coming in 2026 and are preparing for a world where the dollar isn't the automatic safe haven. Jim Rickards, author of Currency Wars and former Pentagon advisor, wrote in November 2024, "The maturity wall of 2026 is the most telegraphed financial crisis in history. Every major power is positioning for it. The question isn't whether it happens. The question is whether the US has the political will and financial capacity to navigate it without losing reserve currency status." Let me give you the 3 most likely scenarios for how 2026 plays out. Scenario 1. The Fed capitulates early. Sometime in Q1 2026, before the June maturity peak, the Fed announces a new round of QE. They preemptively buy treasuries to smooth the auction process. Yields stay suppressed. Crisis is delayed. But inflation reignites immediately. By Q4 2026, CPI is back above 5%. Real wages collapse. Political backlash builds. And the 2028 election becomes a referendum on whether to continue printing or accept default. Scenario 2. The Fed holds the line. They refuse to restart QE. They let the market clear. June 2026 auctions proceed without Fed support. Yields spike to 6.5% or 7%. Stock market drops 25 to 30%. Housing market freezes. Credit market seize. Emergency measures are announced, but the damage is done. Recession hits by Q3. Unemployment rises to 6 or 7%. Political crisis forces policy U-turn, but credibility is destroyed. Scenario 3. Hybrid approach. The Fed does stealth QE through intermediaries. They provide liquidity to banks and primary dealers, who then buy treasuries. Officially, it's not QE, but functionally it is. Yields stay range-bound between 4.5% and 5.5%. Crisis is managed, but not solved. The maturity wall gets pushed forward to 2028-2029. The problem isn't fixed, it's extended. And the next crisis is worse because debt is even higher. All 3 scenarios have the same ending. The US cannot sustain current debt trajectory. The maturity wall of 2026 is just the moment when that reality becomes undeniable. Now let's talk about what this means for individual financial positioning. If you hold long-dated treasury bonds, you're exposed to massive price risk. If yields go from 4% to 7%, a 20-year treasury bond loses approximately 35% of its value. That's not a hypothetical calculation. That's bond math. If you hold cash in a bank, you're exposed to purchasing power risk. If the Fed prints to solve the maturity crisis, inflation destroys cash savings. Real returns go negative. What you can buy with $100,000 today might only get you $70,000 worth of goods in 2027. If you hold stocks in companies with high debt loads, you're exposed to refinancing risk. When corporate borrowing costs double, earnings collapse. Zombie companies that survived on cheap debt start defaulting. Equity values reprice 40-60% lower. The only assets that historically preserve wealth through sovereign debt crises are hard assets with no counterparty risk. Physical gold, physical silver, real estate with no mortgage, productive land, energy infrastructure, things that have intrinsic value regardless of what happens to paper currency. This isn't doomsaying. This is pattern recognition. Every country that reached debt to GDP above 120%, with deficits above 4%, and foreign creditors exiting faced the same crisis. Weimar Germany, post-war Britain, Argentina multiple times, Greece. Japan is living it in slow motion right now. The United States is not exempt from economic laws just because the dollar has been the reserve currency for 80 years. In fact, reserve currency status makes the crisis worse when it comes because the entire world is forced to reprice dollar assets simultaneously. There's a reason gold hit all-time highs in 2024. Central banks bought 1,037 tons of gold, the highest annual purchase since 1967. They see what's coming. They're preparing. There's a reason China is stockpiling commodities. They imported record amounts of oil, copper, soybeans, even coal in 2024-2025. They're converting dollars into physical goods before the dollars lose value. There's a reason billionaires are buying farmland. Bill Gates is now the largest private farmland owner in America. Why? Because when currencies collapse, food has value. Always. So here's the question you need to answer for yourself. Not in 2027 when the crisis has already happened. Right now, while you still have time to position, how much of your wealth is in dollar-denominated paper assets? How much is in hard assets with intrinsic value? And what's your plan if the June 2026 auctions fail? Because the maturity wall isn't coming. It's here. The bonds are already issued. The maturity dates are set. The buyers are already exiting. The math is already broken. The only variable is timing and severity. And based on every historical parallel, based on current trajectories, based on the coordination of rival powers positioning against the dollar, 2026 is when mathematical insolvency becomes market-visible insolvency. This isn't about being pessimistic. It's about recognizing patterns. Your retirement, your savings, your purchasing power, everything depends on a debt system that's exhibiting all the terminal signs. When the refinancing breaks, and history proves it always breaks, the transition takes 6 to 18 months. Those who didn't prepare see 40 to 60% of wealth evaporate, but understanding the pattern gives you an edge. In the next video, I'm going to show you exactly how specific investors positioned before the 2008 crisis, before the 2020 crisis, and how they not only survived but profited while everyone else lost everything. The question isn't whether the debt system is going to reset. History proves it will. The question is, are you going to be in the small percentage who benefits or the large percentage who pays the bill? If this analysis changed how you see the Treasury market and the systemic risk building for 2026, don't forget to hit that like button and subscribe to this channel. We're tracking every move in the debt markets, every signal from foreign creditors, every Fed policy shift in real time. And you won't want to miss what happens when the maturity wall hits in June. Leave a comment with your take. Do you think the Fed will print to avoid the crisis? Or will they let the market break and deal with the fallout? How much of your portfolio is still in long-duration bonds? And share this video with anyone who still thinks Treasury bonds are risk-free, or that the US can borrow indefinitely without consequences. After this, they'll never look at their bond holdings the same way.